I'm going to talk about global R-star, so global long-run real interest rates, with joint work with colleagues from the Bank of England. So there's been, of course, a recent rise in interest rates that I'm sure a lot of you are aware of, but this really follows a multi-decade secular decline in real interest rates. And this has intensified recently the debate about the long-run prospects for interest rates. Where are we going? Are we returning to low interest rate world, or are we now have we left that world and we're in a higher interest rate world? I'm too sure. Sorry. And that really has important implications, not just for monetary policy, fiscal policy, financial policy. So, in particular, one of the kind of key bits of our motivation is the fact that this decline in interest rates has been widespread, so really common across a large set of countries, particularly in advanced economies. Sorry. It's okay. And this suggests that there's common global forces at play driving globally the interest rate. And indeed, in kind of very standard macro theory, including the paper we just kind of saw in the small open economy sense, if you have free movement of capital across borders, you would imply, at least in that long run, where we expect to see freer movement of capital, that implies a single global long run or trend real interest rate, and that's what we're going to call global R-star. And the question is, what have been the important forces that have been driving the decline, the long run secular decline in global R-star? And to answer that question, or at least a kind of important way of answering that question, is to use a structural model. And in the literature, while a lot of individual explanations have been proposed, and a lot of the literature is focused on the US, what we are kind of trying to bring to the table, what we feel is maybe missing in the literature, is a unified structural model of several different candidate explanations, focusing on this global dimension, thinking about the world as a large closed economy. So what we do in order to try to kind of fill that gap is we study these determinants of global R-star using a kind of combination of structural modeling techniques and some reduced form empirical techniques. And what I mean by that is that we're going to build a structural model of the world economy, capturing 5 key kind of potential drivers of global R-star, which is going to be productivity growth, the relative price of capital, government debt to GDP ratios, and 2 demographic drivers, so population growth and longevity or life expectancy. And we're going to complement that by compiling a large panel data set, what we kind of call a global panel data set. In particular, we're going to have 31 high-income countries from 1951 up to 2020. I'll talk about, of course, how we deal with the 2020 data specifically, but that's going to be this kind of long-run panel data set that we build. And we extract the common global trend in each of the time series to think about the drivers of this common global long-run R-star. And we're going to use that to simulate the model. We're also going to use the same set of countries, the same 31 high-income countries, to estimate a reduced form empirical estimate of global R-star, which is going to both be kind of an input into our calibration, but also a kind of comparison against the model simulations as well. And finally, one of the contributions of the paper is that we're going to use a recursive simulation approach. So essentially, we're going to avoid having to assume perfect foresight in our model simulations, and use this recursive simulation approach to capture this idea that beliefs about long-run trends are only updated slowly. So people don't know the full path of productivity growth and so on throughout the simulation. It's going to be just a way of simulating that idea exactly. Is that a question?
So when you say global, you mean developed countries?
Yeah, exactly, yeah.
There's no developing countries with their capital markets blocked and stuff like that.
Yeah, exactly. So, and because it's really about the free movement of capital, what we're going to kind of argue, and there's others in the literature that have done similar, is that our group of countries kind of acts like a financially closed single block. Whereas, yeah, they said like China's not going to be in our group of countries, and we would think of that as potentially a separate driver of
There
our
are
star.
emerging countries with wonderful investment opportunities and a very high marginal product of capital, and you're assuming that capital does not go there.
Yeah, exactly. Yeah, so we're really
Your
just
star moves in the opposite direction of what one would have predicted 10 years ago from the emergence of emerging countries.
yeah, exactly. So I think we think for a large swathe of our from 1950 to 2020 is maybe a better assumption. It's true that it becomes a worse assumption in that sense towards the end of the sample for sure. And I think it's like not the only one, but one of the caveats about thinking about our model as in terms of predicting future path of our star. But in terms of looking back over this kind of 70-year period, we think, yeah, at least for a large fraction of it, it's going hopefully a good.
So we could reinterpret your R star as not being so much R star as a measure of capital market tightness or the excess savings of high-income countries in some sense. Net of
Yeah.
investment.
Exactly. If you think that there's that margin, yeah. Tim.
Yeah, related to that, you may also want to separate between the pre and post Bretton Woods era, because
Yeah.
Bretton Woods era, even advanced economies had.
Yeah, no, that's right. Yeah. I think we maybe have something like a footnote on it in the paper, but yeah, I don't. I think that's right. Yeah.
You had 31 R stars.
And then you would have 31 R stars, exactly. Yeah. Okay, but that's kind of in a nutshell, at least what we're bringing to the table is definitely not the whole story, Martin. Yeah, that is. I think that's a bit more. Exactly, that's more how I would think about it, as potentially as a separate driver of the kind of global R star, being the emergence of other countries and kind of the entry into global capital markets, or them as a potential location for investment, something like that. Yeah. So I'm not going to go into detail on the literature reviews. It's a really kind of dense literature. A lot of, as I said earlier, a lot of different potential explanations have been posed for the secular decline in interest rates. We're going to look at a subset of these, and as I said, kind of missing is a unified structural model for global R star. So there's been some non-structural decomposition of the global concept of R star and some structural decompositions, particularly focused on the US. But not so much bringing those two things together, which is what we try to do. To preview the key findings of the paper, so the dynamics of our model-based estimate of global R star, so the path of R star that's implied by the model simulations, is that we see an initial rise starting from the beginning of our simulation in the 1950s, peaking around the mid-70s, and a gradual decline since the mid-70s. And in particular, there's that gradual decline has amounted to about 3 percentage points, or a little over 3 percentage point decline since the mid-1970s to the end of our simulation, with a kind of level of R star at around minus 0.75 in the final period of our simulation.
So if you have a zero lower bound in monetary...
So this is in real terms.
Sure.
But yeah, you would be...
Real interest rate was even lower than that.
Yes, yeah.
So in some sense, your quantitative conclusion invalidates somewhat, because there is this long-term interest rate versus short-term question, but somewhat it may be interpreted as invalidating the claim that, central banks were right to put us at the zero lower bound, because the R star that was needed was even lower than the R that we had with that monetary policy. But in fact, with the zero lower bound, we had sort of -1, -2% real rate.
So I think,
stimulating
yeah.
the economy beyond I star.
So I think the my kind of short, like, I think you're right, but, and you mentioned the difference between short run and long run, and I think that's really the key there. I think and this, we've spoken about this from, I mean, there is always the disclaimer that I am from the bank, but this is not bank, but since you mentioned the kind of that side of it as well, we do talk about the kind of super, like cyclical or super cyclical forces that have driven R star down over the last, like since global financial crisis, essentially below this big R star, long run R star, sorry. So I think that short run, long run would be the kind of way to think about that. When we compare this kind of model-based estimate of global R star that I've just described here in words, we actually find some that is remarkably kind of similar to the empirical estimate that we also produce. So we kind of anchor them to be at a similar level at the beginning of the simulation, and then let the drivers, let those 5 drivers determine the path of the model-based. And actually, we were kind of like a bit chuffed when we saw that it's actually quite similar across the two of them. And in terms of that decomposition of the role of the different drivers that we, as I said, is one of the key kind of points of our paper, what we find is that the initial rise and the initial peak is driven by higher population growth, so kind of baby boom in that time period, and higher productivity growth then. And that subsequent decline, the 3 percentage point decline since the mid-70s, has been essentially entirely explained by increasing life expectancy and lower productivity growth. And to the extent that, at least in terms of the model, and to the extent that those trends themselves won't reverse, the model tells us that the factors will have a persistent effect on global R star. So there's no reason within the model why the model would revert to a higher level of R star. Those effects would be persistent. So to go over today, very briefly describe the model. So there's nothing really particularly fancy or anything. It's a very simple neoclassical real business cycle model. We're going to have utility maximizing household making the usual intertemporal savings decisions, a profit maximizing household hiring labor and capital to produce. We'll have a kind of small financial intermediary that owns and maintains the capital stock, which comes from the savings of the households. And they also will own the debt that is issued by a government, but is going to be an exogenous kind of stream of debt, or an exogenous supply of debt that is going to be financed through lump sum, or changes in the debt level is going to be financed through lump sum taxes levied in particular on workers. And what I mean by workers is the households in working age in our overlapping generation structure on the household side. So here we're going to have each time period will be 5 years, or will kind of correspond to 5 years. We'll have the households being kind of born or entering the model as economically active agents in age 20 to 24, and then dying or leaving the model as economic active agents in age 85 to 89. And between those, so they'll die with certainty at age 85 to 89, and between those they face a time-varying probability of survival and mortality rate that is going to be one of the things that will change in over the simulations. That results in 14 generations alive in each period, and we're not going to assume kind of a fixed retirement age, but what we'll do is we'll calibrate an exogenous path of labor supply over the life cycle, match that to the data as best as we can, and what we'll see there is that labor supply essentially goes to zero around age 65, and so that'll be kind of essentially 65 will be when we consider agents retired. So particularly the risk-free interest rate in our model is going to map into this idea of global R star. And of course, that's pinned down by all of the kind of parameters and different factors in the model. What we're going to do is consider 5 of those factors to be dynamic drivers of R star, and we're going to really think about them in a dynamic sense, guiding the path of R star. And those, as I mentioned earlier, are productivity growth, population growth, longevity, government debt, and the relative price of capital. And here, the kind of that figure on the right is sort of a stylized, very, very stylized way and kind of static way of thinking about what R star is. It's the price that equilibrates the demand and supply of capital. So the demand for productive capital from firm side and the supply of wealth from the household side. And each of these different drivers, we can think about, again, in a very stylized way, we can think about them as shifting these two supply and demand schedules left and right. So just to go, again, very kind of stylized and high level, how do we think about the mechanisms behind these five different drivers? Productivity growth, we think of it as or decline in productivity growth as a leftward shift in the demand for capital. So a lower expected return on capital reduces the demand for capital from firms. Population growth and longevity, reduced population growth and increased longevity as the age distribution shifts towards higher and typically wealthier agents is going to increase average wealth and be a kind of outward shift in the supply of wealth from households. And the longevity will also have an additional impact of increasing the desired savings due to needing to finance a longer retirement. Government debt, because where this supply of wealth from households is in fact kind of the wealth that's available for productive capital. So it's net of the government debt. And so if you increase government debt, you shift to the left this supply of wealth and kind of crowd out the wealth that is available for private capital. And then finally, the relative price of capital, kind of similar to the productivity growth, is going to reduce the return on capital and shift inwards the demand for capital from firms. And that does depend on the elasticity of substitution between labor and capital, but in our calibration and building on some of my earlier work, that's how we think about the relative price of capital. So having kind of outlined the model, and these are the five drivers that we want to think about dynamically, so what we need to do is to estimate their path in the data. And we do that by building a large kind of long-run panel data set of this group of high-income countries, which we define in terms of their GDP per capita in a given point in time, excluding some potential outliers, and come up with this final list of 31 countries. For most of what we're doing, what we would, we'll be kind of doing a GDP-weighted average of these countries, so adding small countries or like countries that are relatively smaller in GDP wouldn't have a big effect on our results. So it's not really like dependent on on which 31 countries exactly, or if it was 35. If you don't see kind of your favorite countries in here, it won't affect things too much. And I think this is kind of going back to the questioning earlier. What we try to argue is that this is a good approximation to thinking about a single closed economy, or a large chunk of the truly global economies as a single closed economy, in particular because they are highly financially integrated, while the countries we exclude typically are not. And they, at least on average, within this group of 31 countries, they have a small and stable current account position. So it's not a perfect kind of proof of anything, but it's sort of indicative that this is a good approximation of the single closed economy. And finally, we have the sample period for most of our data. We use data from 1951 to 2019, and then kind of essentially assume that the 2020 data is the same as 2019. So when we think about the 5-year periods in the model, we'll have the 2016 to 2019 data standing in for the 2016 to 2020. So we're not capturing any impact from the pandemic within our long run trends. Yeah.
A small question on the sample. Did you try different samples of countries and see if the results change that much? Because you say they're excluding tax havens and then there's Ireland.
Yeah, indeed. Yeah. We didn't do like a detailed thing about that. We could maybe just do it. Perhaps we could do something more detailed. But I think I think we perhaps like at some point added a couple of countries and it really didn't matter, and we convinced ourselves that as long as we're GDP weighting, it wouldn't matter too much, yeah. And so this gives us these figures for the kind of what I'll sometimes call the macro trends, so the non-demographic trends. We have a definition of labor augmenting technology, which is going to map into the kind of technological, or excuse me, productivity growth in our model, government debt to GDP, and the relative price of capital. So here the yellow lines show the cross-country average with this kind of GDP weighting, and the blue lines are the kind of smoothed trend global component of each variable, and this is what we're going to feed into our model as the kind of capturing the long run trend common component of each variable that we think is relevant for this idea of long run global R star.
So TFP is the growth rate, right?
Yes. The annual growth rate of this definition of labor.
So even though it grows at 0.5%, it still grows, right?
Yeah.
And the marginal product of capital is impacted by the level of TFP.
I think it's the growth. Yeah. Yeah. I think, yeah. It is the growth rate that matters, yeah. Yeah. Yeah, I think this is where that kind of supply demand was very stylized. Yeah, exactly. It's
So that's in the long run, in some sense. I mean, in the short run.
Yeah.
In the short run, in a neoclassical growth model, TFP grows by 0.5% between today and tomorrow. What happens to the real interest rate? It goes up in the short run.
It depends what.
Relative to zero.
I'm not sure I understand the concern. I think the sort of
I mean, the Euler equation
the fact that it's been
determines the interest rate in a steady state.
yeah, but the fact that it's been declining. Yeah, not in the one-to-one sense that it does in a steady state, but it does.
Growth does not have to be equal to
But it's still going to be they're still going to be linked through the Euler equation, even if it's not that the relative consumptions drop out. But I think ultimately the path. I mean, I think Anyway, ultimately the fact that the path of labor augmenting technology has been declining, the growth rate has been declining, is going to over time push down on R star, and we'll see that in the decomposition.
Expected TFP growth makes interest rates higher today. So that's the mechanism.
Yeah, fine.
Because people need to postpone consumption. Even out of the GDP.
Yeah, exactly. Yeah. And so we'll see, as I've just been talking about, this long run decline, kind of starting from a slight rise and high levels of labor augmenting technological productivity growth in the early part of our sample, and then this slow and steady kind of decline over the 70 years. Government debt to GDP starts at the high level, I think, essentially because of the post-war period, declines till about the mid-70s and has been gradually rising since then. And the relative price of capital has been kind of well documented in the literature, declined until the 90s and has been kind of flat at a lower level since the 90s. For the two other drivers, so the two demographic drivers, we're not going to do this smoothing, and we're going to really think about the impact of demographics on the long run directly. And we'll take the data from the UN World Population Statistics for our sample of 31 countries, just adding up the numbers and adding up the number of people. And what we see on the left is our series for population growth. So this is again the model consistent idea of population growth, which is the change in the consecutive 20 to 24-year-old cohorts. And so what you see is the impact of the baby boom is kind of 20 to 25 years delayed relative to when we think about the increased birth rates in the late 40s and 50s. And you see it in this big peak in the population growth rate in the 1970s. And since then, it's been declining and very low and even negative values. And then finally, the last chart on the right there is the survival probability, so kind of the inverse of the mortality rates. And this is essentially another way of slicing the data for life expectancy that we saw in the previous presentation. And what you see in this is the survival probability, so the probability that a household at a given age will survive one more period to arrive at the next age. And you see that for kind of the younger cohorts, this has been essentially at 1 or very flat and very close to 1 throughout the sample. But where you see a lot of action is the increased life expectancy of the older cohorts. So from like around age 60, there's been this kind of noticeable increase in the probability of surviving longer and longer, and that then translates into higher and higher life expectancy, particularly in old age. So how am I doing for time, may I ask?
15 minutes.
Okay. Perfect. So what we want, once we have these series for the global common trend component of each of our drivers, we want to feed these that we kind of think of as observed changes in the drivers through the model and simulate the model and get the equilibrium interest rate that comes out of that. And what's really common practice in the literature is to assume perfect foresight and run deterministic simulations, feeding in this stream of exogenous kind of changes and assuming perfect foresight. And this kind of is a particularly strong assumption, and we think it's especially so in our context because we have such a long run simulation. So what we would essentially be assuming is that agents in the early 50s, let's say in 1955, already know the entire path of, for example, productivity growth all the way to 2020 and can predict that perfectly. And we just don't think that that's kind of a useful assumption. So what we do is to kind of design what we think, or at least as far as we're aware, a kind of new way of approaching the simulation that allows us to break the assumption but still keep the actual kind of computation very, very simple. And what the basis of the assumption is going to be that agents' expectations of the future path of all of the drivers is essentially a random walk. So agents will kind of wake up today, observe today's realization of productivity growth and life expectancy and productivity growth, population growth, life expectancy, and so on, and then assume that that's what it's going to be forever. Assume that's the new steady state, the new path of, or the new level of productivity growth, and so on, forever. And then they'll wake up.
They don't even know the law of decreasing returns.
For productivity growth.
We should fire all economists. Because they assume that the future is going to be constant.
They always assume the future is going to be constant.
So after millions of textbooks and papers published,
yeah, or you say as many of
believe the future is going to be a constant.
There's going to be like 10 textbooks that say we're about to grow 10 times faster, and 10 that say we're not going to grow.
They don't read your paper.
They read our paper, and they read also another paper and a third and a fourth, and they see that it's a kind of there's a lot of dispersion, right?
Have the law of decreasing returns. You could say, I don't know that the entire path of productivity growth, but I know that there will be some, and that capital will adjust gradually, and there are decreasing returns to capital. And I could formulate
so they know
sophisticated expectations.
So they know that, but the productivity growth in the sense that we're talking is the exogenous component of it, right? So that they don't have a better prior than whatever I observed but they know the production function, they understand that part of it. And then also to say, no, it's not true uncertainty. And I think part of what we think is kind of neat is you don't have to worry about kind of true, or as in you can do the simulation with the random walk without worrying, are we very uncertain or are we very certain? Like, that's not going to be part of the story.
They just have the wrong distribution of exogenous shocks.
Yeah, it's essentially like this almost a sequence of MIT shocks, right? That's how it is. So it's not even distributions maybe too kind of too sophisticated way of saying it. They just every period wake up and go, oh, okay, productivity growth is lower than I thought it would be, and I think it's so. I mean, you're kind of welcome to think, well, we've just made a different extreme assumption than perfect foresight. We still think it's a useful benchmark, but in some sense, we don't think it's a bad one. Again, remembering that this is about long run, and we have a 5-year periods in the model. So it's sort of, what do you expect average productivity growth to be for the next 5 years? Does the average person have a better answer than whatever they've seen productivity growth be for the previous 5 years? I think it's not too bad of an assumption. We also don't assume any mean reversion in expectation. So it's not that they're kind of not only being surprised, but expecting things to return. They're also not doing that. But you
have looked at that once, assuming that people expect the interest rates to be constant in the future in a Ramsey model, and basically it does not change anything compared to the standard.
For the interest rate to be constant, okay.
Yeah, it does not change anything to the qualitative properties of the saddle path. I mean, it looks very much the same.
Okay, I mean, it's not.
Looks very much the same.
Yeah, I mean, I don't think we're not kind of reinventing the wheel or anything like this. Well, I'll show the comparison of what our simulation says compared to perfect foresight, and it's not going to be rocket science. It's just about how much do you anticipate the future levels of these drivers.
This simulation is like there's a bunch of countries. It's like representative generation that represents all the countries.
Yes, yeah. So it's a single. It's a closed economy that we think of as
like the average of all these countries. Yeah. But it's like a weighted average.
Weighted average, yeah. Yes.
So really, the population of that 31 countries is actually shrinking. The whole population of all those countries is actually shrinking. Not just that, Italy has -1, Japan has -1, the US has 2. You see what I mean? So really, the population of those 31 countries is actually shrinking in total.
It would be, yes, yeah. If I understood correctly the question, yeah. So yeah, we.
Weighted average.
Yes. So because the population data we don't weight, we're counting number of heads, but the sort of productivity and government debt relative price of capital we weight by GDP. But yes, to the extent that we had negative population growth rates towards the end of the sample, that would mean that each year, like each period, there's fewer and fewer people entering, and your totals would start to decline. Yeah. And so this is kind of what we think is one of the novel bits of our paper, and we implement it through a recursive kind of algorithm where we solve the model given today's drivers, assuming there's going to be no further changes, and we kind of solve the entire transition to what would be a steady state, and then take that first period of that solution as the initial condition for our next period's simulation with the new updated levels of the drivers. So in each period, the households are kind of optimizing as if they're going to transition to a new steady state, and then we just take that first period kind of equilibrium solution and then feed that in as the initial condition for the next period. So that basically leaves kind of a few last things to do. One is to set initial conditions for the very first period of the model. So essentially anything that enters the model with a lag we need to set. Where available, we'll use data. So for example, we have the level of the population age structure in 1950, so we can initiate the population age structure exactly correctly in 1950, and then therefore match it exactly throughout the simulation. An important kind of variable that we do have to set is that initial level of the interest rate. So our model is kind of not so much informative about exactly the level, but it is informative more about the change relative to where we initialize the simulation. And so what we do is to take our empirical estimate, which I will talk about in a couple of slides, take the empirical estimate in that 1951 to 1955 period and initialize our model at that level. And then we can think about the model simulations being more informative about the change and the decomposition of the change into the kind of different drivers. We have a few kind of simple parameters to calibrate that we try to do kind of either to standard values from the literature or averages of data over the full sample period. And we do have the discount factors that we typically use to match the level of steady state interest rate exactly through the Euler equation. So we do have something like that here. So we do take our empirical estimate on average from 1900 to 1950, calibrate the kind of initial steady state of the model to that. But because we have the overlapping generation structure, which gives us multiple discount factors by each age group, we have an additional degrees of freedom to also match the shape of assets over the life cycle, so wealth holdings over the life cycle, to match the empirical evidence. And that's going to be like quantitatively quite important, and kind of building on some of our previous work, that retirees in particular tend to retain quite a high level of wealth. So although they, of course, start to decumulate their wealth and start to eat into their wealth in retirement, they still maintain a relatively high level of wealth, and they don't decumulate back to kind of very low levels. And so we match that using these discount factors. And it's going to be important in particular for the impact of longevity on R star. So having talked about everything that we do, so what kind of other results? So here the dark line with the circle markers is the interest rate kind of annualized. Sorry, Axel. Okay, perfect. Is the annualized interest rate, so our model-based measure of global R star within the recursive simulation, and we see what I described earlier, this initial increase in R star peaking around the mid-70s, and this large decline of a little over 3 percentage points up to the end of our simulation. Compared to the perfect foresight transition, so coming back to that question, what we see is that the perfect foresight it peaks earlier and less than our recursive simulation. And that's essentially because they're looking through the early movements and the drivers and already starting to anticipate the future levels of the drivers early on. And so you get this kind of earlier and shallower peak in the path. Qualitatively similar, but quantitatively some impact. And finally, to kind of compare it to, to compare it to the empirical estimate. So this is a estimate based on a VAR following Del Negro et al.'s kind of 2019 paper. Those of you that are familiar, it just uses kind of short run, long run interest rate data, inflation data, and very kind of with very few restrictions. They do it for, I believe, the G7 countries, and we extend the estimate to our entire group of 31 countries, and that's the kind of dark line with the confidence bands around it. And then we compare that to the model-based estimate, which is what I just showed you in the red lines, but remembering that our model gives us these 5-year periods, which is why it's a kind of a step function relative to the annual VAR data. And what we see is, in that very initial period of the model simulation, we've matched those levels and we've put them close together by construction, but the rest of the simulation kind of gives a very similar shape. So this kind of initial increase, a slight peak, and then this gradual decline. The VAR data does have that peak a bit later than what we find. But again, we actually kind of think in that sense, our recursive simulation is moving closer to at least this empirical measure of R star. And then really the final thing is that decomposition into the different drivers. So here we're plotting, again, that level of the real interest rate in the dark line, and now the bars show the contribution of each driver in each period. So we do that just by resimulating one driver at a time and taking the difference in the path of R star with and without the different drivers. And so what we see is that initial peak, as I kind of described earlier, that initial peak in particular driven by that higher productivity growth in the beginning of the data, and then this declining productivity growth, and in particular this large red bars from the increased life expectancy and increased longevity pushing down towards the end of the simulation, and really actually accounting for the entirety of the decline, with other factors even potentially offsetting that decline. So just to summarize the... Sure. Yes.
You say something about the longevity effect, and it surprises me how large that is.
Yeah.
I mean, yeah. How do we think about that?
So this is, so basically, and this kind of goes back to the point I was making about matching the life cycle wealth. So there's kind of essentially a mechanical effect, which is that if you think about your life cycle of assets being that younger cohorts have very low assets, they build up assets peaking around 50, 60, and then they decumulate a bit, but not a lot. And then now you take that profile and then you shift your population age structure to more and more towards, like, put more and more weight on those higher wealth households. And so that is like essentially almost a mechanical effect where your aggregate wealth is going to increase because you have more and more of these higher wealth, or like agents in the high wealth period of life, and that puts a lot of kind of downward pressure on the interest rate. So again, it's that shifting out of the supply of wealth from households, and then there's also the kind of that's kind of the aggregate perspective. From the individual perspective, they're now expecting, whereas they might have been expecting 10 years to live 10 years in retirement, they now expect to live 20 years in retirement, and that increases at least the desire for wealth accumulation and pushes down on the price through that.
Don't you have a countervailing effect when you have a hump of people who are nearing death, they will descend.
Yeah, so we do kind.
In steady state,
So I tried to remember what we did on the very final period, but again, what we match is what we observe in the data, or at least in this paper we do it in a stylized way. In another paper we try to do it a bit more directly, of matching what we observe. And really what we observe is that there isn't this big decumulation, at least until that kind of 80, 85, 90 age group. That you don't see this big drop off and you can kind of model that. So we do that through the discount factors. You can obviously model that through bequest motives and health spending and things like that. But it's really what's important is that there isn't this big, as some people, including maybe Charles Goodhart, think, that there isn't this big party when you're 80 that you spend all of your assets, and that doesn't show up in the
discount factors of the weight on the future in utility terms increases as you age to offset the increasing death probability.
on offspring, it looks like you are trying to have your cake and eat it, no? Because suppose that
I am on my own agent, so okay.
in the sense that if people do not decide when they are 90, it means they do not behave as a life cycle theory. Maybe they behave as a Barrow dynasties, but then you should not have an effect of longevity. No? I don't know.
So I think, I don't think
Save, no?
you save, but then you have some bequest motive. Should I cut it? Yeah. You do have some bequest motive. Maybe I'm having my cake and eating. Maybe that's the conclusion. So yeah, I'm also running out of time, but just to say again, we try to kind of take seriously the idea that these trends are global, and with free movement of capital, we have to think about long-run trend equilibrium interest rates in terms of the global forces driving it, and doing that we find this significant decline driven by productivity growth and longevity. Thanks. Sorry.